Hey guys, what's up? Something I always encourage my friends and family to do and the people I know is to get investing. Investing is a great way to create passive income for you, which if you don't know what passive income is, it's money that comes into your bank account when you're not doing anything for it, or you're sleeping, or you're working another job and something else comes in. It's really nice. It makes you feel great, and it's something we all should be doing. I actually have quite a few different passive income options on my channel. You should check out this video here for that. Today we're getting into beginner-friendly investments for anyone who wants to get into the stock market. And we're getting into it in 3, 2, 1. Hey guys, if you're new to my channel, my name is Theo, and I get on the camera and talk about some of the money I make and some of the money I lose. I am not a financial guru, and this is not financial advice. However, I was a beginner, still am a beginner, and learning every day about how to invest my money in the stock market. And I'm just gonna share with you some things I've learned, and honestly, hopefully you can learn from it as well. The first thing you can get started with if you're a complete beginner is investing in dividend stocks. To first understand what a dividend stock is, you must understand what you are purchasing when you are purchasing a stock. So when you decide on a company after you've done a lot of research and decide this is the stock you want to invest in, when you buy this stock, you are now a part owner of this stock. So let's just take Beyond Meat, for example, because that's a company that I'm also invested in the stock market. I own a portion of Beyond Meat. Beyond Meat is not a dividend stock, but let's just give an example that it is. So let's say their dividend is about 1.00%. For every $100 that's invested into their stock, they will give you back 1%. They'll give you back $1. The main reason people really love dividend stocks is not only with the speculation that the stock is going to appreciate every month, but you also get paid an additional amount just for owning the stock. So it's 100% passive income. On top of that, usually most dividend stocks are paid out quarterly, and that is just stable income for you that you can get every 4 months just for owning the stock. Honestly, I personally prefer dividend stocks because even if the stock does depreciate a little bit, you do recoup some of your money by having a dividend stock that is paying you back quarterly. There are some drawbacks to owning a dividend stock. It's not guaranteed that they will continue and withhold the dividend. Some years it goes up, some years it goes down, some years it stays, and sometimes it disappears altogether. If you are a beginner thinking about getting into a dividend stock, I will tell you that just because the dividend yield is very high, like let's say like 10% or something, does not mean it's a good stock. A lot of times that is the opposite. Usually that means it's probably not a good stock if it's something you've never heard of, if it's something that's depreciating, if the curve is mostly going down but they have a 10% yield. This is not a good stock. Don't put your money in a stock just because it has a high dividend yield. Obviously, if you're not investing a ton of money, you're not going to get a ton of money back in dividend stocks. However, this is 100% passive income that you're getting for doing absolutely nothing once you buy the stock. If you're interested in getting started with dividend stock investing, there is a really great free app called Robinhood. I'm sure you've heard of it, but if you use my link in the description, you will get 1 free stock that you can play with today, and you can trade it, you can sell it, you can buy something else and see how you go. So you can start your journey in investing in the stock market today. My second way to get started in the stock market as a beginner is to invest in index funds. Pretty much what an index fund is a group of companies and stocks that are all in one fund. So instead of going out and picking individual stocks, so picking Apple stock, picking Facebook stock, pick Beyond Meat stock, you're just going to choose the one index fund which encompasses all of them together. There's many different kinds of index funds, but you can do one that has the top 500 performing companies right now. You can also do emerging markets, so new industries, new companies, things like that. But essentially, instead of trying to buy every individual stock, which would be very costly and take a long time, you just buy into the index fund, which has all of them together. Some really great thing about investing in index funds is that it's very diverse. So you don't have to invest in just one industry specifically. It can be across many different different industries. Another benefit about index fund investing is that it's super stable. In general, you're not gonna have a lot of the volatility as you have with one stock because it's all of the stocks together, all of the companies together, and they even each other out. So one stock might go down, one stock might go up. So you have this gradual appreciation over time, whereas if you invest in an individual stock, it's up and down every single day. You don't know where it's gonna go from week to week. The next benefit of investing in an index fund rather than individual stocks is that, in general, index funds outperform individual stocks and also individual investors. Actually, they say that 95% of investors do not outperform index fund and do not outperform the S&P 500. So instead of paying money to have a brokerage or some kind of manage your investment, you can put that money into an index fund, which outperforms individual stocks and individual investors. A very famous quote by Warren Buffett, who is from Omaha, is that if a person were to have invested $10,000, just $10,000 in 1942 in the S&P 500, which is an index fund, they would have had $51 million today. So you can see if you just have a little investment, even of just $10,000, put it in an index fund or put them in a few different index funds, just let it sit and ride, you'll be on your way to financial freedom in no time. You can also combine the first one and the second one together and invest in a dividend index fund. A dividend index fund, so you have a pool of different index funds that are paying dividends. They're stocks and companies that pay the dividends. They're all together in an index fund. So you're getting that appreciation that goes up in theory every year by 6% or 7%. And on top of that, you're getting paid out quarterly with the dividends. It's honestly, for me, that's like a no-brainer. It is like beginner-proof investing right there. My third way to begin your journey as a stock market investor is to invest in a REIT. This is a way you can get your feet wet and become a real estate investor without the tenants, without the taxes, without the repairs, without any other of the drama that comes with owning physical real estate, and obviously without the price tag. What the word REIT stands for is Real Estate Investment Trust. So just like a stock, how you are a part owner of an actual stock, with a REIT, you are a part owner of a property. So what a lot of investors do is they pull money from different investors, so $10,000 here, $10,000 here, $100,000 here, until they have enough money to invest in bigger projects like commercial buildings or multiple multi-family homes or a lot of single family homes. So you can be a part owner of real estate by investing in the REIT. And after that, all the earnings that they make from the property, which is usually from the rent itself, they pay back to their investors in the form of a dividend. So what people really like about REITs as well is that, first of all, it's fairly stable because as the population grows, we're always going to need places to go. Businesses are always popping up. There's medical buildings. We're always going to need places to house these hospitals, etc., hospice and things like that, nursing homes. So in general, real estate is not going anywhere. It's never going to go anywhere. And in my opinion, it's always just going to be a booming industry for the most part. Even in a down market, when people aren't buying houses, they can't afford houses, people are renting. They have to go somewhere. So people lose their homes, but they go back to renting, which is just going to make this stock even better for you. The investors that are buying these properties and renting them out are going to be making more money in this case, and hence comes back to you as the investor of a part owner of this REIT. Another benefit is, like I said, it's a way to get into the real estate market, be considered a real estate investor without actually owning any physical real estate, which is pretty cool. My fourth and last way a beginner can get started in the stock market is with bonds, investing in bonds. So this is probably my least favorite way, but I do think that every investor should have about 5 to 10% of bonds in their portfolio because it is safe. I'm going to get into that in a little bit now. So if you don't know what a bond is, pretty much governments, states, cities, companies allow you to invest into them. So for example, if the city of Omaha has this big road project that they're trying to fund, they can issue bonds to people to pay for a small piece of that plus interest to help pay for this road project, for example. There is a maturity date and there is a set interest rate that you agree upon before you buy the bond. So essentially this maturity rate can range from just a few months to many years, sometimes even decades. For example, I have a bond that will not mature until 2030. I don't know why my mother did that to me, but essentially, depending on the length of the bond and the interest rates, it might be desirable for you as well. What people really like about investing in bonds is that it's a very safe investment. Why? Because if the government is issuing a bond and they can't pay it back, it's, first of all, it's very unlikely, because that pretty much means the government has gone bankrupt. It's chaos, the world is gonna end, it's the apocalypse or something. Very unlikely. So with a bond from the government, you have lower rates, lower interest rates, but it's very secure. So if you have a recession going on, you might have safer returns from a bond than in the stock market. Because if there's a recession, people start selling out of the stock market, you're gonna see a downturn and lots of sellouts, and people are just like going crazy. Or as a bond, it's very safe. You're not gonna get the 7% like you might get in the stock market, but you will usually get around 2% back. Or you can invest in company bonds. So companies pay out a little bit higher because it's a lot more risky. Companies have the risk of going bankrupt, not being able to pay it back. They do offer higher returns, but it is more risky than obviously a government or a city. A great thing that people love about bonds as well is that you know exactly how much you're gonna get back. So if you invest $100 into this bond and the bond is yielding 2% back, so you know if you give them $100 for this bond, in 12 months, they're gonna give you $102 back. As you can see, you're gonna wanna put more than just $100 into a bond to really make it worth it for you. But like I said, it can be as small as 3 months, to 12 months, to 24 months, to as long as 30+ years, depending on the maturity date. So going back to the stock market, you're probably like, how does this have to do with the stock market? You can invest in a bond index fund. So this is a pool of different bonds that you can invest in all together, and you will see a safe return. It's not going to have the volatility of the stock market. It's going to be very safe. You're not going to see much return back from this, probably like 2%, like I said, but in general, it's a lot more liquid than holding an actual bond itself. So like any successful investor, you should diversify your portfolio, dabble in a few different things, have a few index fund, have a few different stocks, have a few real estate investing. So REIT in this example that I gave, have some bonds and some CDs. And that way you're diversified. No matter where the market goes, you have a little bit of something in everything. You obviously want to keep some cash on hand as well. And some people also invest in gold and silver because it's precious metal, and if money just ever disappeared, people would go back to gold and silver, is what the theory is. So there you go. If you like this video at any point in time, you found some value or you learned something, feel free to smash the like button 3 different times, and feel free to subscribe and leave me a comment below to have a conversation. I do read all the comments and I love reading them from you guys. I will see you next week. Bye guys. Hey, what are we doing today? Investing. I own a or